All right, so good afternoon. Welcome to 25 Minutes with Cap. As you know, each month we discuss recent trends in the specialty insurance space. Today, I'm excited to have Kyle LaBarre joining us. Kyle's the Director of P&C Research and a partner at Dowling Partners. Thanks for coming, or thanks for having me.
Thanks for having me.
Yeah. So hey, as we go on from here, if you have questions through the session, feel free to enter them into the chat. We'll do our best to answer them. And lastly, just a reminder, the content of the webinar is the property of CapSpecialty and is for informational purposes only. You're not permitted to republish, share, or quote from this webinar without the prior written consent of CapSpecialty, which can be obtained by contacting marketing@capspecialty.com. So the first thing I wanted to get into is how'd you get into the business?
Well, do you want the short answer or the long answer?
Well, it's a 25-minute discussion, so it's
We'll go somewhere in between.
Sure.
So the short answer is I needed a job. I was a finance major at UConn, graduated in 2006, and
yeah.
Come the summer when sort of real life starts, it's like I need to do something, and I wanted to do something that was at least somewhat related to my major, something numbers related, something finance related. But I knew that I didn't want to go work at a big company, at least not right away. And so I sort of lucked out in the sense that Dowling Partners was looking to hire a couple of young associates. They tried to scare people away a little bit with long hours, weekend work. That for somebody who needed a job, okay,
free lunch.
Free lunch is a great bonus. Free parking, but no, it was. I didn't really know what equity research was, but it seemed interesting enough, and they took a bit of a flyer on me. I'm sure there was other candidates that were probably more qualified from a past experience perspective, or had worked at insurance companies in the past. But I was a numbers guy, and it was. It seemed like it was something I could use my degree with, and here I am 17 years later, still here. And maybe from my perspective, there's the why did you get into the business, but it's also why did you stay in the business? And it's fascinating. I mean, you can it's a profession where you can actually learn something new every day. So there's this constant learning. The people are great. Industry wide, the team that we have around us here is really good. But it's really interesting because you're always learning, and it's always something different. It's never the same thing. I think back to COVID, and whoever would have thought that we'd be dealing with the insurance implications of a global pandemic and what that might mean from an insurance perspective. So that's what's really kept me involved in this business over the last 17 years.
I should probably back up and have you explain to everyone what you do.
Sure. So Dowling Partners is a little bit unique. We're a broker dealer. So we're a sell side equity research firm that publishes research on publicly traded insurance companies. We are insurance only. I'm part of the property and casualty team. So we cover roughly 60 publicly traded insurers and brokers. We've got a small team that also does the life and retirement services companies, and then an analyst who does the title, mortgage, and financial guarantee companies. So the main business is selling that research to institutional investors that hopefully helps them make better investment decisions over the long term. What's a little bit different about us as well is we publish a weekly newsletter called the IBNR Weekly,
Sure.
Which goes to the institutional investors, but also it's pretty widely read within the overall insurance industry at the more senior levels. And so the idea of the IBNR Weekly is sort of all things that matter to property casualty insurance that happened over the last week. We've summarized and analyzed those trends, and hopefully it's a way for a busy executive to take a couple of hours over the weekend to get caught up on all the trends that matter within the business.
As an analyst, how do you differentiate yourself?
It's tough, right? It's there's a lot of people who do it. There's a lot of information out there, so it's tough to sort of stay ahead. From my perspective, I look at what Dowling's sort of pitch is, right? We're insurance only, so we're not going to be the all things to all people.
Mhm.
We're pretty narrow, and if we're gonna be narrow, we've gotta go deep and really understand the trends, the companies, the history,
Yeah.
how it all works. And so, for me, how I differentiate myself, you basically do that. It's, you've gotta know, you've gotta know more, you've gotta understand why. And, I find you've gotta understand the history of the companies, the history of the industry.
Yep.
And you can't do that, without really going deep. And so for the way I differentiate myself is you gotta be more sort of in tune with what's going on and understand more about the business and how it works in real life. We can all plug numbers into a spreadsheet, and forecast earnings and growth, but sort of understanding the intricacies of the business and how it really works in practice is something that we spend quite a bit of time working on, talking to people, sort of getting smarter on the business in real life.
Now, I got to imagine some of the stuff that you say is not always the most popular thing with the different people who may manage or run the companies. How do you balance the relationship building side, with the need to have an unbiased reputation?
Yeah, no, it's a great question, and it really is a balance. I've learned much of what I know about the insurance industry from talking to and, becoming friendly with people in the business. And the nice thing about insurance, at least it seems from my perspective, is that people are very willing to help out and, help get you up to speed if you show an interest in it.
Sure.
But I think, I think one of the things that we've done over the long term is people trust that we're going to publish what we actually think, and we're gonna talk to a bunch of different people on any given topic. So, we always like to say, we're never gonna bag somebody and just spew their opinion.
Sure.
We're gonna learn it ourselves, do the work, do the analysis, but also check in with people and find out, what are we missing? What could be better? What are the other factors that we need to be considering? So, everybody's got some agenda when they talk to you, whether it's, actual or, just, unconscious, but, you gotta take that with all the other conversations you have, and ultimately you gotta write what you think is correct.
Sure.
And, sometimes that means people are a little bit upset, and sometimes, they think you did a good job. Not gonna make everybody happy all the time.
Sure. So getting into the business and some of the periodicals that you read, I think one of them talked about 2020 ushering in the E&S golden age. Well, golden age is a positive connotation, but 2.5 years later, people are still dealing with pain. Are you surprised?
In some ways, yes. If I step back and you ask me to, sort of lay out what do you think is gonna happen in E&S over the next 2.5 years?
I have that question.
I'm sure whatever I came up with is gonna be a lot different than what actually happened. So in that sense, yes, you're always a little bit surprised by, what happened. One thing I never would have guessed was that E&S is approaching 20% of the commercial lines industry.
Sure.
I mean, we sort of were at 9, 10, 11%, not that many years ago. And it's really, the growth is really ramped up. So, we never were gonna be able to get it exactly right. But
What do you think has driven that growth?
well, I think in some ways, it's the fact that here we are 2.5 years later, and companies are still dealing with issues. They're not mutually exclusive. The fact
Sure.
that you've got reserving issues, you've got, lack of profitability in certain lines at certain companies, that's part of the reason why the E&S market has grown as much as it has.
Sure. Does this market, really, I guess, this point in the market, does it remind you of any other market at a different point in time?
We get
Was
that
it new?
We get that question a lot. And I'd say it's probably a little bit of both. Now, I'll preface my comment by saying, while I'm one of the old guys here at Dowling, having
Sure.
been here 17 years, I don't know if I've even seen a full cycle.
Right.
I certainly wasn't around during the liability crisis in the 80s. I wasn't around during the the soft market of the late nineties, early 2000s. I basically started at the tail end of, the hard market in the mid 2000s. So, certainly we have got people here that have been in the business longer, and you get some perspective from them. There are certain things that seem like is always the case in a cyclical business. Ultimately the cycle is driven by, fear and greed.
Sure.
And, in the end, things turn when companies start losing money, people start worrying about their jobs. So in a sense, this cycle is no different than past cycles where, the turn in pricing is driven by a lack of profitability, a destruction of capital, big reserve charges. That's all sort of the same. But every cycle sort of has its own unique drivers, unique factors. E&S is sort of interesting to my mind, because we talk about both the secular and secular changes. And the cyclical change, the outsized growth is probably a cyclical phenomenon. It will slow at some point. But E&S being a much larger piece of the overall commercial lines business, that feels secular to us. It's, whether it's the wholesale brokerage community doing a better job packaging up business, having expertise that's useful to the retail market. E&S is just going to be a bigger share over the long. It might not be 20% always. It might not be 25%. It might be in the mid-teens or something. But there are certain secular changes within E&S that sort of make this cycle feel a little bit different than past cycles.
A lot of the commentary from people as they're talking about the result has been around social inflation. Is that what it is? Or is it just old-fashioned reserving optimism?
Yeah, to me, it feels like it's a bit of both. Social inflation does, at times felt like a convenient excuse for having gotten the reserves wrong. But when you look at things like the change in makeup of the jury pool and the general dislike of corporations, or the fact that lawyers are getting involved earlier and more frequently, they've got better data, better technology in terms of sort of learning what to go after, which companies to go after, which jurisdictions are more favorable to certain claims. Whether it's just the funding, litigation funding. I know there's a number of insurance companies that will call it legal system abuse, which feels like an appropriate term a lot of the time. Those things do feel different. And it's harder to track social inflation. I'm sure you guys have tried to do some of that work as well. It's a little bit softer. Sure. But when you look at sort of the average settlement values, the cost of claims, that's all gone up. Some of that is normal loss cost inflation, but some of it feels like it's this social component where, increasingly the demands are for limits right away. And each time you've got a new nuclear verdict or nuclear settlement, that resets the bar at a higher level. So that does feel a bit different. But let's face it, some of it is just, over the long term, loss cost trends are what they are. 5, 6, 7%. And we went through a period of time where for a number of years, it ran well below that. And now we're at a period of time where it's probably running a bit above that, which again, over the long term, you'd expect that to happen. I do think, and look, we're guilty of it too when we try to analyze the reserves. It's hard when you're looking at trends over 5, 6, 7, 10 years, and things continue to trend favorably, loss costs remain low. It's hard to sort of bake in an inflection point and say, no, it's changed now. The loss pick should be higher. Sure. Inflation's right. So it's easy to sort of get caught up in that. So I do think part of the issues that we've seen on the reserving side is a factor of that. Part of it is a factor of social inflation and things just costing more.
A lot of times when people are talking about the business, they're talking about the 15 to 19 years and the 20 to today. Do you all have a house view on the 15 to 19 years?
Yeah, and in fact, the Schedule Ps are recently released.
Sure.
We're going through that analysis now. We've obviously reviewed the 10K triangles for the publicly traded companies. So hopefully we have a fairly up-to-date view of that. But yeah, 15 to 19 has been a challenging block of accident years for the commercial casualty lines in particular. So the, general liability, management professional liability, commercial auto. And then we'll lump the liability reinsurance lines in there as well. Companies and the industry have taken a lot of adverse development to date. Some, over time, some, more recently with some larger charges. And looking at some of the trends coming out of the 10K triangles and, the Schedule Ps that we've published on to this point. It does look like there's probably, a bit of noise left to go in the 15 to 19 years. Maybe 15 and 16 getting closer to the end, just because they've had some time to age. The more recent years in that block still look like there could be some noise. But it does seem like we're sort of past the worst of it at the industry level. The interesting piece, and you mentioned it, was, what about the 2020 to 2022 accident years? And I think there was a general perception that those were going to be very good years. The analysis that we've been able to do to this point, 2020 looks like it probably actually is a very good year. There was, whether it's on the workers' comp side, just, people working at home, not traveling, or even on the GL side, you don't have the same number of slips and falls at the grocery store because, people are ordering delivery and stuff. So that year, it doesn't seem like the inventory of claims is as high. And so even if the severity is a bit higher than we thought, that year is still pretty good. 21 and 22 still look like they're probably pretty good years, but I'd say in the work that we've done, they're probably not as good as what we would have thought initially. And my sense is the companies sort of feel that way too. And
why do you think that is? Or why do you think your initial thought was different than what you're thinking?
Yeah, it's a great question. So I think initially you look at the acceleration that we saw in pricing, and you didn't quite know what the loss cost environment was going to be, right? So you're baking your rates off of what happened in the soft market, but also COVID threw off a lot of trends, and then we saw this big spike in both economic and social inflation, and sort of taken a while for the courts to reopen and sort of work through that backlog. So you were getting price, but you didn't have a great sense of what the real loss cost environment was. At least that's my sense as an outsider. And so I think what's happened is loss cost trends for the 15 to 19 years ended up being worse than what people thought at the time they were writing business in 2020, 2021, 2022. And so that flows through into how you think about what the loss trend should be for those years. But also you see that it really hasn't died down. In fact, there was an acceleration in 21. Maybe inflation's not increasing as much. Maybe we peaked there, but it's generally inflation has been higher than we would have thought at that point. And so, yeah, you got the benefit of the higher rates. You will probably recognize the benefit of improvements in terms and conditions over time. You probably didn't take a lot of that in initially, but you've got a loss cost environment that, maybe you thought it was 5.5%, 6%. And in reality, it's coming in, the companies that disclose it, it's somewhere between 6 and 7% for casualty, and higher on the excess side. That probably wasn't baked into your pricing at the onset. And so that, from our view, that's sort of what we're seeing as we look at the accident year profitability in the more recent years.
Shifting a little bit to InsurTech. So you've been a follower of the InsurTech trends. There's certainly been enough think pieces and told you so's about what's gone wrong. What have people done right?
They've done some things right. The focus on technology, better manipulating, managing the data, ease of use, this idea of improving the customer experience, those things have value. And the insurance business generally isn't known for being on the leading edge of technology. And, I think for the last few years, I had never heard insurers or brokers refer to a net promoter score or anything like that. So, we sort of had our way of doing things,
Right.
and it worked for a long time,
Yeah.
and we stuck with it.
Yeah.
And then you've got these upstarts that say, hey, look, there's a better, more efficient, less costly way to do it. And so I think some of the things that the insurtechs have introduced, that it's helpful to the overall market.
You think anything's gonna stick? I mean, which parts of it stick? I mean, because, yeah, they're good ideas,
Yeah.
but they also need to be, profitable underwriting.
Yeah, look, insurance is a tough business, and in the end, you have to make an underwriting profit. You got to make money, and some of them have had some difficulty doing that. Part of that is where we are in the cycle. Part of that is cat losses, things like that.
Sure.
But I think the idea of trying to strip costs out of the system is something that will definitely stick. I mean, you look at the expense ratio at the industry level. You're basically you're in the when you factor in LAE as well, you're 35 points or so, some lines of business higher than that of every premium dollar is going to expenses. And so anything that we can do as an industry to sort of reduce some of that cost, whether it's technology, whether it's AI and large language models, those things have value. And I think that the insurtechs have at least in some cases have done a nice job in sort of pointing out those inefficiencies, and have done some interesting things to sort of streamline that process and make things better for the customer.
Do you think you'll continue to see sprouting up of new independent businesses in that respect, or is it gonna be more being built out through existing companies? Or both?
I suspect we'll see both.
Yeah.
And look, this may not be insurtech specific, but you look at the number of MGAs that have started
Sure.
over the last couple of years, or the
Sure.
number of fronting carriers that have, there's new business models being formed. You've got talented underwriters saying, look, I don't want to deal with the balance sheet, but I've got a good track record, I've got a good team.
Yeah.
I can find the right capital to help support that, but it doesn't have to be my capital. So yeah, I think we'll see more startups along the way, but I also think you're gonna see continued consolidation amongst the insurtech market, whether it's traditional carriers or brokers buying up some of the
Sure.
smaller insurtechs that have capabilities that they don't have, or even acquisitions amongst insurtechs. We've seen a few of those along the way to just try to get some better scale, a shorter pathway to profitability. So yeah, I think we will see both over the next several years.
Awesome. So hey, last question. So, from the 17 years of experience and developed expertise, give us some predictions on what's gonna happen in the industry.
Yeah, it's well, I sort of gave away one of my predictions in that, the 2020 to 2022 accident year is gonna be an interesting block of years to look at, and may ultimately help to extend the cycle, certainly in some lines of business where there's issues. So I think that's certainly something to keep an eye on. I'm also just sort of curious how, and I don't know if this is a prediction or not, but we've seen double-digit growth within the E&S market for, I think it's 6 straight years now, if we look at the 2023 data. Our view more recently has been evolving on what happens in E&S, and we think we're closer to the end of that outsized growth than the beginning. I think we said we're in the later innings of that process, which I think is different than what most people are saying at this point. And we still see very strong growth. We saw it through the fourth quarter. You still see strong double-digit growth from the stamping office data.
Yep.
But when you look at E&S, it feels like we're getting closer to the end of that outsized growth. So that I'd say that's one of my predictions as I look out to probably more so 25 than 24.
Great. Well, hey, thanks. That's our 25 minutes.
Look at that.
So, thanks for the time. Really appreciate it.
Thanks for having me.
Thanks for
It's
joining.
great.